Welcome to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next week. Hi guys, welcome back to Macro Insight. Today is the 19th of January, and let's take a look at the markets. So before we talk about equities, normally we start on equities, but I think this week, before we talk about equities, we need to talk about sort of the big drivers in macro land at the moment, right? And those are basically the dollar and US treasuries. So let's start off with the DXY. We've been talking about the DXY. Obviously, it had got very oversold. It started to stage a bounce, and that bounce is kind of in progress. And, you know, from the lows of around low 89s, the DXY got to almost 91, right? 91 was a bit of a level, a bit of a resistance level. My target potentially on the upside was 92. I think that's a bigger resistance. But for now, on the first test of 91, it's failed, right? But that move in the dollar is basically driving everything, right? So whereas the last few weeks has been very much reflation trade, all of the reflation assets have been rallying, dollar's been weakening, and as a result, we've seen commodities flying, we've seen equities flying, you know, we've seen even gold and silver were kind of doing okay, you know, very much that narrative that we're going to get a global recovery due to massive fiscal and monetary stimulus everywhere, pretty much. And then we're also going to get a vaccine rollout on a scale that we've never seen before. And things are going to kind of go back to normal, and the market's risk appetite was there, and it's pricing all of that back in, right? Now, this reflation narrative it's got two sides to it. It's either we really are going to get global synchronized growth, and it is the correct view and it is the right trade, or it's just that we've seen a weaker dollar because everyone's bearish the dollar, because everyone just thinks that the Fed is just got no option but to just keep printing, right? And the stimulus in the US, now that Biden's in, is just going to keep coming and keep coming. So that super bearish dollar view is being kind of translated to a reflation view, but it's not necessarily true reflation, right? So in true reflation, where you actually expect recovery, global recovery, you should be seeing things like European equities potentially outperforming. You should be seeing things like silver outperforming gold, because silver's got industrial uses and things like that, right? In true reflation. But arguably what we've seen recently isn't necessarily true inflation. It's just dollar weakness being translated into the other side of dollar weakness, which is higher commodity prices, higher EM, higher equities, right? So that's kind of where we're at. So this chart is going to pretty much determine what goes on over the coming weeks. So if this dollar move isn't quite done yet, and like I say, for me, I mean, if we break back below this sort of 89.70 level, then it may well be it's over, and the dollar's going to take out the lows. So for now, the jury's still out. I would say, you know, we are still in the dollar up move, probably. It's not quite done yet. But this is going to be the main determinant of where macro goes, basically, right? So keep an eye on DXY. And then also, like we're saying, the backup in interest rates that we've seen in the US. We'll bring up the 10-year chart. So as you've had this reflation narrative and this global growth recovery narrative kind of kicking in, bond markets have started selling off, okay? Because people's expectations of inflation have been rising. And if you're expecting inflation to come through, and you're expecting the Treasury issuance of more and more debt to then finance all this fiscal spending that they're going to do, that leads bonds to sell off, and that leads yields to rise, right? So you can see on this chart, 10-year yield was kind of, you know, ticking along in a bit of a flat line around that 90 bips level, and then when it broke, it kind of jumped up here to about 120, okay? And if we look at a long-term chart on 10-year yields, you've got this big downtrend in 10-year yields, which we're kind of getting close to testing around 120, 125, okay? So people are getting a bit nervous that, and generally, the idea of yields going up isn't necessarily that bad. I mean, look at the absolute level of yields, it's still only 1%, right? So you don't need to panic, but if yields jump too aggressively and too quickly, that's when markets tend to get a bit nervous, right? There's a lot of debt in the system, right? There's a lot of debt on the balance sheet of the Fed. There's a lot of debt in the corporate space. So generally, you don't want yields to be gapping higher at too aggressive a rate, right? That tends to spook markets, yeah? So it's more the velocity of the increase that is concerning than the fact that it's increasing. If it's increasing, but it's doing it at a nice, slow, soft pace, then that's okay. If it jumps too aggressively, then the market gets spooked, okay? So right now we're in a bit of a Goldilocks scenario, right? Because it has had that little jump up, but now it's stabilized. If it takes out 125 on the 10-year and it goes quickly to 150, then I would expect to see the market get a bit spooked on that. When I say the market's spooked, the sector in particular that tends to be quite sensitive to rates is the tech sector, right? Because the tech sector, the valuations in the tech sector are sky high and they're on the moon, but they're being justified by low rates, right? If rates start to go up, then you start to find it more difficult to justify these high valuations in the tech land, right? And that's a counter argument, and you start to see money come out of the tech sector potentially, right? So in historical bouts of yields ramping up, you've seen nervousness in the tech sector and you've seen corrections in the tech sector. So that's something to be watching. So if that yield does creep its head above 125 again, you should expect probably to see the NASDAQ under a bit of pressure. So here's the S&P chart. I had been, like I said, I had been looking for a bit of a consolidation, a bit of a correction in equities last week, as I mentioned in my call. We did get like probably the worst week for the S&P since before the vaccine news came out around the election. However, that doesn't say much. I mean, literally, we got highs of 38.30 down to lows of about 37.50. So we're talking about an 80-point correction is all we managed to get. In the context of how much we've rallied, that's pretty poor, right? That's not really managed to correct much. So for me, it's done the minimum. If you look at these Bollinger Bands, right? So these Bollinger Bands show you the kind of 20-day average and then the two standard deviations either side. So we've done just enough. We got back to that average. So we have done just enough in terms of a correction to then be able to carry on and rally and just continue with this uptrend, particularly if the dollar sells off. I think that's what will happen. But, really to feel like the corrections, really more meaningful, I'd like to see us get down towards this lower Bollinger Band, which would take the S&P down to around 3670, between 3650 and 3700 area. That would be a much nicer place where you would feel like, okay, we've corrected, we've taken out some of this extreme bullish sentiment, yeah? We've unwound some weaker longs, and we can then now start to rebuild the rally and continue with the uptrend, which we think is going to persist for the next 3 to 6 months, right? It does feel like everyone's come into this year very bulled up, very long equities, right? And that needed to be unwound. Now, whether that was unwound already by just that little bit of weakness last week remains to be seen. As a technician, I think it's not done yet. I think we should look for a bit of an ABC type structure where the A move was that first leg down. We're doing a B wave bounce, and we can see a C wave that will get us down towards hopefully some of those blue support levels that I've drawn, where we could call that a complete correction, right? But for me, I think there's definitely room for that correction to persist over the next couple of weeks, right? That's what I'll be looking for, right? So I wouldn't be limit long the reflation trade right here, right now, certainly in equities. Okay, I'd let them come out with their earnings. So JP Morgan and Citi came out with earnings last week. Stocks kind of sold off a bit. You've got Goldman's this week. You've got Bank of America. you've got Morgan Stanley, you've got all of those this week. So what I'd like to see is those guys come out with their numbers. Maybe the stocks come off a little bit, but those companies are now allowed to buy back their own stock again, right? And that's a big driver, right? If you think about a lot of what drove the equity rally sort of pre-2020, it was corporate buybacks, right? Particularly in the tech space and other sectors, right? The banks can now do buybacks, right? So you think about all of this liquidity that the Fed injects into the market, right? The people who get access to that liquidity are not you and me on the street, right? They are the banks. The banks get access to a lot of liquidity, and now they've got the option to buy back their own stock, right? I suspect the financials stocks are going to be well supported now that that is something they can do, basically, right? So, and also if the yield curve does continue to steepen, that's bullish for the financials as well. If the recovery does kick in, that's bullish for the financials as well, right? So as a recovery play, as a reflation play, getting into the financials on a dip, like this XLF ETF in the US, is probably not a bad one. And it's probably one that I would favor more than piling into a load of the small caps and the mid caps, right? So that's certainly something that is on my radar to be a dip buyer in, basically, right? If we can get a pullback to this sort of average level here, then, I'd probably be looking to get some exposure to that. And, you can do it via outright ETFs or CFDs or whatever, but you could also get involved on the options space, right? And there might be some nice option trades to get long financials, like call spreads or something like that. Maybe 3 months out, call spreads will probably offer you some half decent risk reward, right? So that's kind of how I will be looking to structure it myself. They're saying crowded longs right now are Bitcoin, tech, short dollar, and small caps over large caps, right? Those are the crowded trades. So if you think that's what everyone's got on, that's what the consensus is, maybe that needs to be unwound a little bit before it can continue. The bullish sentiment and the extreme bullish sentiment normally comes along with a low VIX, right? The VIX is the price of volatility, it's the price of protection, right? But the VIX is actually quite high. If you look at where the VIX is, the VIX is around 22, 23, and the VIX futures are much more expensive, right? They're about 25, 26. There's quite a lot of premium in the VIX. And if you look at what the realized is and how much the market's actually moving, it's only moving on a 13 vol. So 13 versus 26. So implied vols in the options market are double what realized vol has been. Yeah. Normally that only happens when the market is nervous and afraid of something, right? So what you've seen is markets taking out the highs, but yet people are either owning protection on the downside, or people are not willing to just buy the market, but they'll buy a load of call options, right? So if you think about what's driven the market up since the trouble last year, a lot of retail buying, a lot of speculative buying from the retail crowd. And the way the retail crowd buy the market is a lot of them use options. They buy call options on some of their favorite tech stocks and things like that, okay? And what that does is that filters through to the volatility market and takes all the dealers short volatility, which is what makes the VIX stay elevated because all these guys are short, right? So this is telling us that potentially, even though we're at all-time highs and there's very bullish sentiment, maybe a lot of the buying has been done via call options. And so any pullbacks that we get don't need to be too dramatic because people are protected in the way they're long the market, basically. Right, so they're protected because they bought the market via calls. So you may well get pullback from overbought levels or extreme sentiment levels, but that pullback will probably be pretty short-lived and probably won't be very deep because we've got an already very elevated level of VIX, right? If we had a very complacent and a very low level of VIX, then you might get a situation where it could snowball and get a bit out of control, right? But right now, it's indicating to you that the street is hedged enough, basically. The street isn't like just in a vulnerable position that we're going to see a 10, 20% sell-off quickly, right? And let's be real, 10, 20% sell-offs quickly only happen when the market sees something that it wasn't expecting or it wasn't aware of, right? Whereas, any escalation of COVID is not going to be a big surprise to anyone. And the market's just looking past it, basically, right? The market's saying, yeah, we know COVID's going to get worse for the next few months and lockdowns are going to be here, but the vaccine rollout's going to be here by summer and the world's going to look good again, basically. And in the meantime, we're going to get your amount of stimulus every time we need it. from all the central banks all around the world, right? So that's what the market's pricing, yeah? The market's pricing that central banks will save the day until vaccines save the day, right? But something's going to save the day, basically. That's kind of what the market seems to be coming to, that consensus conclusion, right? So gold obviously had its period of weakness on the back of real yields having a bit of a pop, and just yields in general popping. Like I said, that 10-year yield going to 120-ish. So gold's kind of come off. It kind of briefly touched 1800-ish, but not for long. Didn't stay down there. Bounced quite violently off there, and now it's around 1840. So gold, I mean, it's got decent support around this 1800, and then that next support level is 1760. We look at that, zoom out a bit on the gold chart. Below there, you kind of got support again around 1670, 1680. So I do think that if this reflation trade kind of does continue, and you continue to see yields go higher towards 150, then I suspect you will see gold stay quite weak, right? As that kind of narrative of recovery and everything comes in. But there will be a point where the market doesn't like yields going higher. And what will happen then is that the Fed will come in and they will do yield curve control. And they will come in and they'll backstop the treasury curve, and they won't let it steepen anymore, basically, right? When they do that, that will be a massive buy signal for gold, and gold will scream higher, right? So what you want to do is you want to start picking up gold as it reaches these support levels, as we start to see yields go higher in the US, and you want to sort of be timing that for when you think that yields have got to a level where the Fed's not going to let them go higher anymore, and that's what will happen. That they'll turn around on the back of the Fed implementing yield curve control. Yeah, but I don't think we're not going to get yield curve control at 120 on the 10-year, right? I don't know where that magic number is on the 10-year where we're going to get that. Some people think it's 150. Some people think it's like 2%, right? But it's definitely not 3%, right? It's somewhere between 150 and 250 probably, yeah? And it's probably also depends on the velocity of that yield move and the state of the global economy as that yield move is occurring, basically, right? So there's a lot of moving parts to it, but the point being is when they step in and they cap yields, then gold's going to scream. Yeah, that's what I think. Because once they cap yields, then what they're basically saying is, even if the market recovers, inflation can keep going higher, but we're not going to let yields go higher with it, basically. And so then real yields are going to drop, right? And when real yields drop, that's when gold rallies the most. Yeah. Price action in these commodities is telling you firmly what people are believing on like where commodities are headed, where the dollar's headed, and where inflation's headed, basically, right? A lot of people don't like the idea about saying that we're going to get inflation because there's these big structural forces that have prevented inflation from coming through, right? And those haven't changed, like demographics and technology, right? But in the short term, the commodity markets are signaling that there is a bout of inflation, right? Whether it's due to supply chain bottlenecks that's driving it, a weak dollar that's driving it, whatever it is, there is, asset price and commodity price inflation is clear to see on any chart you want to pick, right? So don't bother looking at CPI, tells you nothing about inflation, yeah? Look at what asset prices are doing, look at what commodity prices are doing. That gives you a better read on what's happening to inflation, basically, right? They'll do what they want to do to manipulate the CPI basket so that inflation doesn't show up, right? And it looks like their policies are working, but that's not really the case, right? Their policies are driving up the cost of living. They're certainly driving up the cost of assets. So the rich who own assets are getting richer, and the poor who don't own assets are going to find it even harder to get assets, basically, right? So these policies are not great for society. That's my view. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com.